So the IMF has just dropped its latest report on Pakistan's economy. And believe me, this one is a big deal. This isn't just some dusty document. It's the scorecard that global investors use to make decisions worth billions. Today, we're going to tear it down piece by piece and figure out what it all means for the market. And more importantly, for you. Let's get right into it. You've probably seen this number splashed all over the news, right? $1 billion. It's the latest shot in the arm the IMF has approved for Pakistan. But is it just another billion? Or is there a much bigger story hiding behind that headline?
Look, this is about so much more than just cash. It's a massive vote of confidence. Think of the IMF as giving a huge thumbs up to the rest of the world's financial markets. It's their way of saying, hey, Pakistan is serious this time. They're getting their house in order. And that signal is almost as valuable as the money itself.
All right, so here's our game plan for this economic checkup. We'll kick off with the latest update. Then, we're going to look at Pakistan's report card. Did we pass the test? After that, we'll see what the new economic forecast is telling us. Then we'll get into the nitty-gritty of the big reforms being pushed. And we'll wrap up by looking at the risks still lurking on the horizon.
Okay, let's dive straight into the details of this new money and, figure out where it fits in the grand scheme of things.
So this $1 billion brings the grand total under this particular program to $3.3 billion. Now this steady flow of cash is absolutely critical. It's not just about padding our foreign reserves, it's about signaling to everyone else that Pakistan is a reliable partner. That confidence is what keeps other doors open for financing, hopefully on better terms.
Now, it's really important to get this. Our relationship with the IMF is not a new thing, not by a long shot. As you can see here, this is a long, complicated story that goes all the way back to 1958. We've been through program after program over the decades, each one trying to fix the economic challenges of its day. The program we're in now is just the latest chapter in a very, very long book.
And this chart really puts things in perspective on a global scale. Right now, Pakistan is the fourth highest borrower from the fund. And that's not just a statistic. It shows you how deeply our economy is tied to the IMF's support system. It's why every review, every single press release gets put under a microscope by the market. Our external stability really hinges on this partnership succeeding.
Okay, so let's get to the performance review. This is where the rubber meets the road. We're going to check the economy's vital signs against the targets the IMF laid out for us. So, the big question is, how we do?
Well, the scorecard is actually pretty strong where it counts the most. As you can see, we hit our targets for net international reserves, for the state bank's domestic assets, and for government guarantees. Now, the one area we missed was the cash transfers under BISP, but, and this is a crucial detail, the report says this was because of some administrative savings. The actual spending on the core support programs was higher than planned.
And this gives you the bird's eye view. We hit 86% of the most important targets. Those are the quantitative performance criteria. These are the make or break numbers, so that's a solid pass. But then look at the secondary goals, the indicative targets, only a 50% hit rate. And that tells a story, doesn't it? We're managing the big picture numbers, but we're struggling with that next layer of reform.
And here's where some of those struggles are. The misses on those secondary targets were in really critical areas, like FBR tax collection and spending on health and education. This shows you the core challenge perfectly. We're getting better at stabilizing the economy, but the really hard long-term work of broadening the tax base and investing in our own people, that's where we're still falling behind.
So based on that performance, what's the IMF's new prediction for Pakistan's economy? Let's take a look at the doctor's prognosis.
This comparison is fascinating. The IMF has trimmed its GDP growth forecast for fiscal year 26, bringing it down to 3.2%. But, and this is the key takeaway, look at the other numbers. Inflation is now expected to be lower, and the fiscal deficit is projected to shrink quite a bit. The message is clear. The new strategy is all about slower, but much more stable and sustainable growth.
This quote really sums up the new philosophy perfectly. The priority has shifted. It's stability over speed. We're basically agreeing to slower growth in the medium term as the price for getting inflation under control and putting our fiscal house in order. For any investor, this is a massive signal. The focus is on consolidation, not on a risky sprint for growth.
So what are the actual policies behind this push for stability? Well, that leads us to the structural reforms. And these aren't just about hitting targets every few months. Think of these as the long-term lifestyle changes prescribed by the IMF for a healthy, sustainable economy.
First up, we have to talk about the elephant in the room of Pakistan's economy: circular debt. For years, this tangled mess of unpaid bills in our energy sector has been like a ball and chain on our growth. It is a huge, complicated problem, and this IMF program is designed to finally tackle it head-on.
And here is the three-step plan to do it. First, take the existing mountain of debt and package it into a government-backed sukuk. This is a huge move to clean up the books. Second, make sure that tariff hikes happen on time so that prices actually reflect the true cost. This stops the bleeding. And third, keep doing these adjustments regularly so we don't end up right back where we started. It's a systematic plan to finally break this destructive cycle.
But the reform agenda is much bigger than just energy. On the tax front, there's a promise to end tax amnesties and finally align the agricultural income tax. Our big state-owned enterprises are supposed to be reformed under a new law, a move that could unlock a ton of value. And in trade, the plan is to get rid of special incentives to create a more competitive, level playing field for everyone.
Now, no economic checkup is complete without hearing the doctor's warnings. The path to recovery is never a straight line, and the IMF report is very blunt about the potential challenges and risks that lie ahead.
The IMF flags several major risks. Outside our borders, global tensions could make commodity prices spike. Inside, there's always the risk that political instability gets in the way of reform. Then there's something called policy slippage, which is really just a polite way of saying we might lose the political will to follow through on tough reforms. And on top of all that, you have a fragile financial sector and our massive exposure to climate disasters.
This quote right here is the IMF's final verdict. It's a message of, let's call it, cautious optimism. The good news, our ability to pay our debts is better. But, and it's a huge but, that progress is fragile. It could all fall apart because of the risks we just talked about, and it all depends on two things: sticking to the plan no matter what, and getting the financing we need from others to see it through.
So that leaves us with the final, ultimate question. The diagnosis of the problem is clear. The prescription for the cure has been written, and all the warnings have been issued. The path forward is going to be incredibly difficult, but it's also clearer than it has been in a very long time. The real question now is just about will. Will this be the time Pakistan finally sticks to the hard road of reform to build lasting economic stability? For investors and for the entire country, the stakes have never been higher.